Welcome back to Show Me the Money Film Financing. I'm Sam Coppola. I'm here with Jon Mechanic. Jon, the last episode itself, we talked about what was called tax shelters, tax credits, film tax credits. That's known as soft money, and that's because of the fact that it doesn't have to be paid back. What we're going to explore now is other types of film funding, where essentially that money has to be paid back in some form or another, or at least the people or the entities that are giving you that money may be expecting part of it back, either in money back or some form of other participation with you in the film. So the first part, we call that risk money or hard money, is and it goes back to the historical way that Canada had, and even the United States had started, was that you would have tax funds. You would have tax incentivized investment into the film industry. And historically, it was a tax shelter. But those tax legislations exist still in Canada, and they also exist as a form of tax financing when we talked about tax credits in those other countries. In Canada, you don't have to claim the tax credit. You can actually structure a film where you get an investor that puts up money into that film, and then when that film is made, the investor can actually deduct the investment they made in your film against their tax. So you can still structure money on a tax-favored basis. There are two ways of doing it. One of them is a direct investment. In other words, you go and the person buys a share of your copyright of your film. Another one is, let's say you create your production company. Your production company can issue shares to investors, right? They put in money into the common shares of your company, the production company, and the production company produces the film. And let's say that the film doesn't work out, doesn't recover its money itself. Because of the fact that they put in their invested in shares of a private company, usually, they'll be able to take a loss, which is called an allowable business investment loss, when that company, let's say, is shut down or no longer has funds or is insolvent and can't pay.
And that's how these tax shelters started, right?
Essentially, historically, you were able to make it advantageous because the percentage of deduction was not like now it's 30%, per year, but those deductions went as high as 166% in Quebec, in the late 80s. So that if a person had a tax rate of 50% and had a write-off of 166, from a Quebec standpoint and 100% federally, you were looking at 70% of your film was given back to you, or your investment was given back to you in tax. So you were at risk maybe 30% of it. And that film then only had to produce 30 or 35% revenue on its budget, and you were able to make money. That still has a potential of being done today. The difference is that you'd have to renounce to the tax credits if you're doing it in that fashion. However, you can still combine it with tax credits if you do it through a corporate structure and the film fails, and then they'll take a deduction, not on the film, they'll take a deduction on the shares they invested in your company. So that's another method of, let's say, alleviating the loss, for these film people that come in. Internationally, as we saw before, we had seen Belgium, we had seen Ireland, remember? And they had a percentage of their amount that was in a film incentive. That film incentive is actually a tax shelter structure where people come in, they basically invest inside a limited partnership. That limited partnership or other structure invests in the film, and they're able to take those tax deductions, and that's how you finance part of that tax credit equivalent. So those are risk investors, because in reality, when they put in their money, they weren't giving it to you. A tax credit is, i.e., the government, you don't pay it back to the government. Here, the investor, even though is at risk, the investor may be expecting back the money. But it's alleviated by the fact that there is a tax advantage to having invested in the film industry. The other one is public funds. I think you're aware of some of these public funds themselves. Maybe you can talk about those.
Yeah, well, public funds, effectively the government, apart from giving, at least in Canada, right? The government is responsible for administering tax credits, right? But these are kinds of monetary assistance or monetary funds that are available in a manner other than tax credits. So, for example, SODEC in Quebec is very active and has various programs, right?
Yes, SODEC itself will finance, and if you look at it, they'll finance films, television, live entertainment, music recordings, and so forth. So that is it's an agency of the government, and these film commissions in different jurisdictions in Canada and in federally and provincially, all of them have discretionary funds. The difference with tax credits is a tax credit, to me, the definition of a tax credit is money is not contingent on someone liking your film or making a decision to invest in your film. In these situations, you're standing in line, you're filling in an application, maybe you have to write a story about Canadians and telling Canadians and so forth because Telefilm would prefer a story about Canadians, and the funds that they have are limited. So that means that if you have to do your application by a certain date or you have to meet other requirements, you're not assured that you're going to get this money. So these are themselves discretionary types of funds. In certain situations, these funds are refundable. Telefilm, for instance, will buy a share of your film. Okay, they'll own a part of the copyright, and they're expecting that if the film makes money, that they would get repaid back. In fact, Telefilm, as mentioned in an earlier episode, started where Michael, what's his last name again? Spencer had told the Canadian government, give me $500,000, okay, and I'll start a film fund that will self-generate itself, which is now turned into millions of dollars a year, essentially, and still not generating enough back to be self-financed itself. So those are public funds. Internationally, you'll have the same type of situation where you'll have, if, for instance, if you go to Berlin, they have the Landesbank area, for instance. So if you go into if you film in one location because they want to promote filming in that location where there used to be a studio, they'll give you a percentage of an investment from there. If you go in Puglia in Italy, which is in southern Italy, which is an area that has still an economy which is agrarian-based economy, and they want to promote more tech and more investments in that zone. Puglia has a fund in Italy that will invest side by side with the tax credit of Italy and be able to finance part of the film that is done over there. So all these funds themselves, again, harder money because they expect to have some form of return back for it, but available to add on to the tax credit financing that you have.
Right. And those are your public funds.
Yeah.
But now let's talk about private people, private funds.
You have some experience on that private fund. I think one of your films actually had pretty much financed. It was a small budget picture, but it was financed a lot with private money.
Yeah. So the first question is, who are these private investors, right? Could be anyone. Mm-hmm. Who do we see very often now? We see people who aren't in film, who are creative, who like film, who want to get involved somehow in that process. Mm-hmm. Also, very often, people who maybe have a familial connection in the entertainment industry, somebody, maybe a son or daughter or a partner who is an actor or an actress, and they'll make their investment contingent upon that person appearing in the picture.
A vanity investment.
Very often, groups of professionals, right? The joke is always groups of dentists out in the prairie somewhere, pooling funds together and investing in a film. So it's various people for various different reasons. But we've also seen these investments structured in different ways, correct? I think akin to what you said before, there's outright investments in the company. There's share purchases, which are very, very different. Why don't you kind of do the compare and contrast since you mentioned that, from a tax perspective?
Well, the ones where they're investing in equity themselves are usually, like you said, funds maybe from groups of people who have an interest in the film side. You have seen a series of offering memorandums where they go to accredited investors, and so you can still raise money through this type of equity. There's been a crowdfunding type equity investment that was permitted. If you look actually at crowdfunding, this is a recent situation. For instance, under Indiegogo, right now there was a film called Code 8, Robbie and Stephen Amell. They actually raised $3,249,000 Canadian dollars to produce a film called Code.
What was their minimum on this? I don't think Indiegogo has a minimum requirement. I think Kickstarter has a minimum requirement.
I think they had a lower threshold than that number, and they basically said, we shot a film, but what you're getting in crowdfunding, okay, is essentially you're getting a recognition, you're getting possibly a credit at the end of the film. You're getting a DVD of the film. You're getting free tickets to it.
You're walking the red carpet, which for a lot of people is a super fun, cool experience.
Kickstarter, for instance, in Tribeca, apparently last year, there were 12 Kickstarter-funded films that premiered at the 2018 Tribeca Film Festival. So you're looking at crowdfunding now as a serious form of actual investment and financing of films. Now, don't forget, you could crowdfund and combine that with those credits that we were talking about. So this doesn't have to mean that this is 100% of your financing. This is part of the financing, and this is what I would call investors. So there was a documentary called United Skates, another one called When Lambs Become Lions. So 12 films actually got financing through Kickstarter themselves. There was a film that we participated in called Blue Mountain State, which was a television series that was cut by the broadcaster, and they decided to do Blue Mountain State, the film itself. And the people who actually financed Blue Mountain State, because they had stars that backed it itself, were actually able to raise, I think, over $1 million on Blue Mountain State movie as basically the way to fund most of their equity. So it was an interesting component. Another recent one, which is actually live as we are speaking, is called Silo. The film Silo is financed by your own private screenings. So in other words, if you want to participate right now in financing this film, you would host the screening. And you pay a license fee on it. And basically, you would make your money from becoming your own film exhibitor. If you noticed, a lot of this is in the central United States area. One of them is in a barn, okay, in Lafayette itself. The other ones are in different cities, Freeport, Illinois, in a university area, Lansing, Michigan. So people have actually put up money in a private way of do
me a favor, check out Grinnell, Iowa. There's a pretty prominent liberal arts college there. I'm wondering whether this is a lot of college schools.
Wait.
Iowa, to the right. One up, above Missouri.
Hold on. No.
Yeah, right there.
But you're in Des Moines. No.
Grinnell, hang right.
Right?
Yeah, down the 80.
Down the 80.
Yeah, I have spent time in Iowa, as you can clearly tell,
okay.
Right?
I don't think so.
I wish I had a laptop right now.
Wheatland.
Well, I think, like you're saying, this is the heartland, right? You're right over Grinnell.
Yeah. Grinnell. There it is.
One down. Oh, it doesn't say.
It says Grinnell view in Google Maps.
Yeah, but this is the heartland, right?
Yeah.
And it's playing on, I guess, your built-in audience.
Yeah, yeah.
One thing that is worthy of discussion, I think, here is the relationship between investors and tax credits and grind downs.
Mm-hmm. Well, if you have what is called assistance, okay, where the investment is made and isn't refundable, then technically, if you want to claim a tax credit on it, your tax credit is calculated on the is lowered by the fact that that money is not at risk.
Right. And the interesting point there is we talk about hard money and soft money. The soft money is like, okay, it's forgiven. We don't expect anything in return. The hard money, depending on whether it's repayable or not,
Mm-hmm.
can be forgiven or it cannot be forgiven, right?
Mm-hmm.
And one of the things that CAFCO says and that the legislature says is it conflates assistance with this notion of a forgivable loan.
Mm-hmm.
Like, we're advancing you money, but, and they'll actually say it in far more precise wording, but the idea behind a forgivable loan is we're advancing you money, but if we don't get it back, it's all good. You're free and clear,
Mm-hmm.
right? The antithesis of a forgivable loan is like a bank loan, right?
Mm-hmm. Yeah, which is because collateralized,
And
secured, and so
that's
forth.
it. And there's all these different ways that an investment can be structured, and they either fall more towards being a bona fide loan with an expectation of repayment, or they could be an investment that there is very little expectation of repayment, and that would definitely trigger a grind down. So it's important to keep these things in mind, and I think actually be able to spot that one issue so you could address it however best as possible.
But again, the tax credit is only a percentage, right? If you're able to raise hundreds of thousands of dollars through risk money, investors that are coming in, you would still want to take that money because it's a dollar for dollar.
Sure.
The other one is only a percentage that they're giving you.
Right.
So still try and raise that money in getting these risk investors in there because it's giving you direct money, even though you may have to pay it back because the tax credits themselves on the other side of the coin are only a percentage of that component.
Right. And I think the next form of private money is kind of like movie magic a little bit, right? There's a level of sorcery when people find out that this is a possibility, and it's deferrals or deferments. So very often, persons who are involved in a film, the producer, an actor, an actress, a director, anyone at all, they could actually say, look, you're paying me $60,000 for my role in this film. I'm going to take 50. I'm going to defer $10,000, reinvest it back into the film, and maybe I'll take some ROI. And it's important to distinguish, right? Because there's pure deferments and then there's reinvestments, right? A deferment is I'm going to defer this money until some fixed point in time. It could be a date. It could be an event. Like, for example, if you have an interim bank financier, who we're going to talk about in a subsequent episode, banks will often say, look, we want this person to defer this much until we're paid out in full in cost, principal, and interest. So that's a deferment. A reinvestment is more along the lines of, I'm actually taking this $10,000 and investing it back into the film for some expectation of ROI.
Yeah, the surprise on the reinvestment is the fact that they actually send the check over for the full amount of your, let's say, your $60,000 that you said, and then you reinvest it back into the film. You have income of $60,000 that you have to put on your tax return and pay tax on, okay? And that $20,000 is not a deduction against your income tax because what you've done is essentially a loan. If you look at it, you've invested in a film, you can't write off that investment on day one. So you've got to be careful on deferrals versus reinvestments. There's an actual difference between a tax liability on the reinvestment side.
And one other thing worth adding here, and you can speak to your experience as well, is from what I've seen, the first person to defer / reinvest, or I should say more accurately, defer or reinvest, is the producer, maybe a writer, maybe a director.
Directors.
Exactly.
Often directors. I mean, if I remember correctly, James Cameron in Titanic reinvested his entire director fee.
But basically, these are the people who really want to get this thing made. The film is their baby. And then, further down the line, I've seen actors and...
Well, and also service companies. For instance, I mean, these days you have an enormous amount of money that is spent on visual effects. And you have film budgets that may have $20 million of visual effects on it. You're giving a contract, let's say, to one, maybe a couple of companies, $20 million contract. These companies are making money from it. They have an interest. So they're able, if you have a big supplier who's making a lot of money from your film, you're able to leverage a little bit of that.
It's also a way of, in my view, we talk about gap financing in the bank sense, right? Which we're going to talk about more in the other episode. In effect, like deferrals are another way of plugging a gap, right? So when I talk about this is magic, it's sorcery a little bit. If you're a producer and you were able to raise 90%, right? And you have your 10% producer's fee and you are the most confident producer in the world and you love this movie so much and you want to get it made, you just say, okay, I'm reinvesting my producer fee, gap filled.
That's it.
Right?
Called green light.
Yeah.
You green light the film at a certain level because of the fact that you know that you're making a certain amount of money from that film. You can green light the film.
Yeah, exactly.
In fact, there are companies out there who are, let's just call it diversified, right? In other words, the film producer isn't just one guy sitting, with a couple of other people in an office. There are film production companies that have studios, cameras, lights, and different types of post-production facilities that are all owned by the same group of companies. Those companies could potentially greenlight their film, let's call it, at maybe 60%, 70% of the budget. Why? Because the rest of that money is actually their own fees that they're basically charging into the film itself.
Well, there's also
the television production.
I mean, there's also a level, there's an aspect there which I think is important, which I'm not sure that we've really discussed in this podcast, which is that risk as a producer is informed by how many pictures you're producing, what's on your slate, what's on your plate, right? If I'm producing 10 features in a given year, I probably know which ones I'm willing to take a bit more of a risk on. And I know which ones I need to be a little bit more conservative on, or at least I have some idea, or I think I know, right? If you're producing one film, you need to determine whether you're more risk level.
Well, you need to pay the bills, so you're not going to green light your picture and invest all of your money in there.
Exactly, but that's why studios typically have been more stable than indie prodcos, right? Because studios have such a huge amount of output, whereas an indie studio will produce anywhere between like 0 or 1 and like 10 pictures a year, for example. So one failure for an indie prodco hurts a lot more than one failure for a studio. Similar principle. So those are your deferrals, your reinvestments. So what's next?
Well, those is what I call the balance sheet side of the equation, in the sense that you're looking at taking on the liabilities component of it. And as you know, a film is an asset, right? So it's an intellectual property asset, and that asset itself can generate revenues. So what you do is to basically finance your film, is to generate that revenue ahead of time. So that's called, by entering into pre-sales or pre-license agreements, you're able to then what you've done is you've sold your film now. So the other way, what you were doing was you were getting an investment in the actual production. Here, you're basically reducing the value of your film by pre-selling it. And so the next area that you get a lot of area of potential financing is something called sales and licenses of rights. And in the sales and licenses of rights, the areas are, you first usually look at your own country, right? Your own province, state, country, and so forth. And you try to find somebody who will, i.e. pre-buy this film as you remember, if you do a content film, you're almost forced into that because you have to have the film shown in Canada. So you're literally being obliged to get that pre-sale. You don't have to actually sell it for a preset price. But the moment that you need to have somebody who is willing to show the film in Canada, you're literally being asked to pre-sell that film. And that right can vary depending on the nature of the film. It may be that you're selling too early, okay? Because of the fact that if you're in Canada and you don't do the U.S. Sale itself, the U.S. being a major market, especially on the English side, you're basically short selling a little bit of your asset to be able to just finance the production.
In theory, though, and I'm just going to play devil's advocate. Like I know that that's the case, but in theory, you are able to have a negative pickup. We are going to get to negative pickups, but negative pickups, just so everyone understands this, are the opposite of a pre-sale, right? A pre-sale is you're buying in advance. A negative pickup is you're actually selling the negative. The distributor picks up the negative, or at least that's the way it was in the old school days, the days of yore, right? So the film is done. It's signed, sealed, and now you're just basically saying, hey, want my movie. But in theory, since shown in Canada within 2 years is a question of fact, you can theoretically have a negative pickup and hit that requirement, right? It's just less safe.
Well, it's, again, when you do the negative pickup, you're selling your entire film. You're essentially selling a territory. You're selling, the copyright is divisible in the world, right? So you can divide copyright through uses, right? In other words, theatrical distribution, television distribution by media, and you can divide it also by territory. So you can actually sell an entire copyright for an entire territory within that. So you're basically sold your film for that and never have to receive it. A pre-sale is usually, or a license is usually not a full sale. You're essentially getting a minimum guarantee or an advance against the royalties or the revenues of that jurisdiction.
Right. And that's an important point, I think, actually, because sales and licenses are so linked to copyright, right? So what you're talking about here, when you're saying copyright is divisible, right? You have different jurisdictions have a different way of dealing with this, right? If I were, we're in Quebec, so a Quebec lawyer will probably talk about, okay, copyright consists of multiple dismemberments or démembrements. In common law Canada, in common law UK, the language is always, I'm holding copyright, which means I have a bundle of sticks, right? And what that basically means is, if I'm holding a bundle of sticks, if I'm holding my copyright, I could give one person one stick, which is the Canadian rights. Or I could give them one stick, which is like English rights worldwide. I could cut the stick in half, which is saying, okay, I'm only going to give you certain rights for 10 years. The whole stick represents perpetually.
Well, 50 to 75 years, depending on your copyright registration.
Exactly. But that's really how all these licenses work, right? You're basically just doling out sticks from that bundle. And I've always liked that metaphor because it makes it very, very easy to visualize. So, okay.
If you sell the world, you've sold all the sticks.
Exactly.
That's what I meant by, i.e., your asset is gone.
Yeah, exactly.
And if you sell it up front, then you're basically not going to make much money, or you're going to see much money after.
Okay, so back to really the stuff of this last part of this episode. We were talking about, okay, you're going to try to sell your domestic rights,
Domestic rights. And the domestic rights in the United States usually means Canada included into it.
Exactly.
Yeah. But the U.S., if you're doing an English language film, now again, theatrical and so forth, but even if it's not theatrical, the U.S. represents probably the biggest territory, but it's the most unknown territory where you can't really predict what the film will actually make.
I think traditionally the world value allocation for a film was 40% to U.S., U.S. including Canada. So that's almost half of the exploitable value of a film.
Or 40% of your sticks.
Yeah, exactly.
Exactly. But What the outcome is an unpredictable outcome after that. In other words, you could be selling your film for 20% or 30%, and yet there could be very little money coming out of that territory. Let's assume you said, my film is $10 million. I'm expecting $4 million from the US and Canada. Well, if you don't sell it, you may get $1 million only from it because of the fact that essentially you don't have any way of knowing what that film will perform.
The flip side, though, and I think we talked about this in an earlier episode, is I could pre-sell my US rights for 40% of the budget, right? Mm-hmm. Let's say it's a $1 million picture. Mm-hmm. I get a 400K MG. Yeah. I haven't made the film yet. Mm-hmm. I make the most awesome film known to humankind. Mm-hmm. It generates $100 million. Mm-hmm. I'm kind of left saying, nuts, I wish I held on to this thing longer, right? So there's always a bit of gamble there. Mm-hmm.
The international represents, again, many of these countries, the big countries are divided up into major territories. So if you look at then selling your film internationally, and where do they sell the film? Is it these film markets that we had mentioned before? So there you're looking at Europe. The major territories in Europe are the UK, Germany, France, Italy. If you talk about like numbers and statistics and so forth, somebody can actually go through that and say Germany should represent a certain percentage of your film, and if you add them all up, maybe again you'll get another 30% of your film coming out of those territories. Then there's Australasia, there's Japan, Korea loves apparently English language, or call it films, and these days China. China is going to be, or actually not China. China is a major market. And the only issue with China is the fact that China wants to consume its own film and own film culture. So the Chinese market doesn't necessarily represent for a either European or American or Canadian producer a huge market itself, but it actually is generating these days probably more revenue than any other territory if your film is theatrically released in China, or can have any type of life outside of that, being able to be seen by the billion Chinese that are there, even though they don't tend to pay a lot of money for it.
Well, and at least traditionally, I haven't done the research recently, there has been a quota system on the amount of non-Chinese or non-domestic films allowed into the country. And what's complicated that, have you done any research, or have you had any conversations about that?
Well, I know that there's the quota system. They basically will remove your film if it's too successful. In other words, if you hit, I don't know, $20 million of box office or $50 million of box office, that film will be yanked and it won't make any more money. The only way that film would continue to be shown is if it was a national film. And Canada has a unique opportunity because it has a film treaty with China that says that if your film is a Canada-China co-production, it is recognized as a Chinese film, not subject to those quotas. So it can, stay longer than the 20 weeks. I think 20 weeks was the longest or something on the theater, and it can make more than the maximum box office itself.
Yeah. One of the things that I found when I was doing that, I did some comprehensive research on this a few years back on the quota system. And one of the challenges that I had was I found that the information that existed out there was incredibly opaque. The most comprehensive piece of literature on the subject was a very wonderful paper, very comprehensive. It was the most comprehensive thing. It was probably, it was lengthy enough. It was detailed, but it was a capstone thesis from a student at Duke University. So there wasn't a tremendous amount of literature at the time that I looked at this. And, as a consequence, there wasn't a tremendous amount of information. So that, from what I could imagine, makes the entire thing a little tricky.
Yeah, they basically have me worry with MAD, China film quota.
Is that Alfred E. Newman?
Yeah, it looks like it. The quota is the number of films also, In other words, they started at 10. Now they have 20 films in 2002, 34
It was 30.
films.
It was around 34 or 35
Yeah.
last time I checked.
And then there was a challenge to it and so forth. So this whole China market, which is probably the largest, if you look at it in population size, the biggest market itself, is a closed market because of the fact that the Chinese want to actually protect themselves from the foreign culture taking over and possibly affecting the young Chinese minds that go into films themselves. So I think it's a political policy that is overflows itself into cultural.
But yeah, I mean, how many times have we seen this stuff, right? When we're doing these notices of assignment and acceptances, which tweak the terms of a distribution agreement, we've seen distributors object to some pretty crazy things in films, which I think would offend our morals, right? If you want, you could mention some examples, but
well, I'm just trying to say that each of these markets, when you're financing your a film itself, when you actually have to go there and get those agreements together, it's a challenge. It's and doing it prior to the film being completed, that's another story. There's another form of financing which we sometimes see, and sometimes it's a little bit subtle, and it's sponsorships. Little bit difficulty sometimes to actually do, because if you go with a sponsor, essentially you're closing yourself off to anybody else because of who the sponsor will be, corporate and so forth usually. I mean, but we sort of all know that the way that you could actually have as a selling technique is the fact that your product or a product that is consumed in a film can actually be paid for by someone who wants to see their product in the film.
Some people abhor product placements. In certain films, if the film is right, they work fantastically. I think the Bond franchise uses products the most seamlessly, right? Like you are wearing the Pierce Brosnan
the
Omega Seamaster from GoldenEye, right?
It.
And Omega has partnered with the Bond franchise since '95, right? I haven't, really scrutinized what kind of product placement deals have been made, but in that kind of film where Bond is effectively an aspirational lifestyle brand in a way, right? Like he is a lifestyle James Bond, right? So attaching all these kinds of products, it works quite well.
There's even the James Bond Club that basically is worldwide and basically themselves raise part of the money. The James Bond International Fan Club, the James Bond Canada. The brand itself attracts so many other abilities and it's a little like merchandising. What you're actually merchandising here is the content of the film. And I can't remember which film it was, but I think Dunkin' Donuts was behind some part of the investment on a film. When you see in a film any mark that is prominently displayed, okay, it's probably either they got permission to do so, right? And or usually they have a product placement or a part sponsorship.
I would add though, and this is a little in left field vis-a-vis sales and licensing, but on that note, an interesting misconception. Trademarks in films, right? There is nothing really out there, as far as I understand, that says you can't show a can of Coke in a film. But there are two kind of general rules there, or two exceptions, which are you can't disparage the brand or the trademark, and you can't use it in a way other than as intended, where you wind up seeing like producers get permission or say, hey, would you like to actually sponsor and partner with us on that, is studio policy. Studio policy says, don't show this trademark for too long on this picture. Otherwise, that's contrary to our own studio policy.
And also broadcasters. because broadcasters have agreements with their advertisers. So if Pepsi, for instance, is going to advertise on a station, they don't want to see Coke inside the film.
No Coke, Pepsi.
Or the other way.
Some people out there will get that reference.
I'm just saying, essentially that's what you're looking at. You're creating a situation where by having that sponsor, you are closing off yourself to situations where there have been deals made with other different brands that are there.
Okay, so that's sponsorships.
Yeah.
And then there's studios, right? Which are effectively the negative pickups that we were talking about.
Yeah, and studios these days, it doesn't have to be the major studios, because now Netflix is a studio to me. You could be doing a film today where your pickup is essentially a streaming company. And my understanding is that Netflix, for instance, will basically buy your movie and worldwide to your movie and assures you of a certain amount of money that you've made from it. And then they can show it as much as they want.
Mm-hmm. And that's a very different kind of producing, right? Mm-hmm. If you're producing under that kind of model, there's less risk, there's less reward, but there's reward, right?
Well, just think about it as follows. If your movie is picked up by a studio, they paid you a certain amount of money, they distributed worldwide, and you now are known as either the producer or director of that film, all of a sudden, your goodwill, your reputation in the industry would allow you to possibly make it much easier to finance your next film. Because the financing of films is mainly driven by, in the United States, the stars, right? So your ability to attract top stars. In many other countries, by your ability to attract top directors. So you just produced a film where basically you didn't have the upside. You did it as a pickup, or you did it for Netflix. But now all of a sudden, you're able to say, hey, I've got this other film. And, do I want this actor to be in the film? And I go to the agency, the agent who represents that actor. And that actor says, well, he did that film. All of a sudden, there's a greater interest to participate in a picture with you. And what you did is all you had done was sold your film in the first one, but it was successful.
Awesome. So I think that just about wraps it up for this episode. Mm-hmm. In next episode, we're running all the way to the bank.
Well,
right?
We pre-sold it. We got commitments from either investors or broadcasters. Now what do? We know we're going to get tax credits. We know we're going to get these sales and so forth, but we need the money.
Exactly. Running to the bank. That's where the bank comes in. Yeah. Who are the banks? What do they do? What's Bridge? Yeah. What's Gap? Yeah. What's Super Gap? Mm-hmm. Thanks so much for listening, everyone. Stay tuned for the next episode.
And just for those who have missed our first few episodes, we're going to take another drink this time.
Yeah, if
from
you insist.
The Shelburne Vineyard Marquette wines. Here we go again. Again, this was also part of the financing of the product. And then finally, you see the product at the end.